A portfolio statement can show an unexpected and significant loss from a previously stable holding. The urgency to make quick decisions can be overwhelming, even when the core fundamentals remain unchanged. Confusion arises when anyone can call themselves an investor simply by purchasing stocks. Without a clear framework for analysis and risk management, decision-making devolves into mere speculation about future price movements. This cycle transforms usual market fluctuations into a pattern of consistently selling low and buying high over time. It creates ongoing stress as each price change feels like a personal evaluation of one's wisdom. One individual checks stock prices constantly, hesitating to implement a strategy because every decline appears threatening. Another person pursues trends and then becomes paralyzed when prices drop and negativity dominates the news. You will gain a succinct definition of what investing truly means, alongside a structured portfolio policy and tools for maintaining discipline to minimize emotional errors. This video draws inspiration from The Intelligent Investor by Benjamin Graham. So subscribe for more insights into grounded investing principles. A successful investment relies on comprehensive analysis, with principal safety and expected returns serving as the evaluation criteria. Any investment failing to meet these standards should be considered speculation, even with abundant confidence. When trading is misclassified as investing, logic is upended, leading to a focus on short-term price trends. Buying after price increases and selling after drops results in locked-in losses, with volatility becoming a source of self-inflicted pain. One investor analyzes financial statements, reviews debt levels, and ensures they pay a reasonable price based on earnings. Conversely, another buyer craves excitement, panicking when prices drop and blaming external factors for their decisions. The smart approach mirrors owning a stake in a business, rather than merely trading ticker symbols. A true business owner understands that market quotations can be misleading, while the actual underlying value shifts gradually over time. Formulate a one-sentence test for each purchase to clarify what could undermine your initial analysis. Maintain a watch list with target prices and rationales, ensuring that your actions are rooted in thoughtful analysis rather than sensational headlines. A straightforward policy blends high-quality bonds with common stocks, maintaining that balance throughout market cycles. This strategy suggests keeping stocks between 25 and 75%, with bonds making up the difference. This approach safeguards against excessive risk-taking during market booms and mitigates paralysis during downturns. It also diminishes the lure of forecasting, providing a consistent framework for decision-making. When stocks rise sharply, this strategy compels selling portions of gains and reallocating those to bonds instead of doubling down. When stocks experience significant declines, the same principle encourages gradual buying during fearful moments without abandoning your investments. This method acknowledges that future returns remain uncertain, but disciplined behavior is within our control. It views asset allocation as a protective barrier, steering clear of extreme behaviors and maintaining a balanced perspective. Choose a baseline mix that aligns with your temperament and set calendar checkpoints to rebalance at regular intervals. Monitor your savings rate and living costs, as these factors matter more than trying to time the market perfectly. The margin of safety is about purchasing at a low enough price to absorb errors and unexpected setbacks. Valuation determines your success, relying on the price you pay rather than simply being optimistic, providing essential protection. Without this safety margin, even a small error in earnings or interest rates can derail a solid plan, leading to losses. With a buffer in place, time and dividends can work in your favour, allowing you to ride out temporary market declines without needing to sell. Overpaying for a popular company can leave you vulnerable if growth slows and expectations change. Acquiring a solid company at a discount allows you the patience to hold on, as value exists even when it's not celebrated. This approach shifts your focus from trying to predict market movements to controlling your entry price and assessing asset quality. It also complements diversification, since no single analysis can provide complete confidence over the long term. Create a checklist for evaluating value, balance sheet strength, and price, then ensure there is a clear discount before making a purchase. If the concept of buying with a margin of safety resonates with you, subscribe for more strategies to make your investment decisions clearer and more straightforward. Dollar cost averaging allows you to invest a consistent dollar amount at regular intervals, irrespective of short-term price fluctuations. This strategy automatically buys more shares when prices drop and fewer when prices rise, reducing the impact of market timing. It minimizes the need to predict market turning points and lessens the regrets that come from emotional timing decisions. This method also instills saving discipline, as contributions are made on a set schedule rather than based on personal mood. One employee channels a portion of each paycheck into a retirement plan, making investing a priority before daily expenses. In contrast, another employee waits for the perfect moment, often losing out during times when the news is overwhelming and unclear. Formula investing thrives when it supports a sensible strategy rather than attempting to chase after market patterns. When combined with broad diversification, it helps make market volatility a useful tool rather than a source of stress. Schedule automatic transfers to investment accounts on dates that align with your income and regular bill cycles. Review your plan annually to check on allocation and costs, steering clear of frequent adjustments that mimic market timing. Consider market prices as offers from a hypothetical partner who may be optimistic or pessimistic on any given day. Your task is to take advantage of those offers when they are beneficial, not to treat them as directives to follow. When prices dictate your actions, mood swings can start to feel like commands, leading to repeated and costly missteps. The biggest risk often comes from within, as fear and pride can disrupt analysis faster than any news headline. During market upswing, your partner may present a high price, making selling seem unwise. Conversely, in a market downturn, this partner may offer an unreasonably low price, leading to hesitation about buying. A disciplined investor evaluates price against value and requires a margin of safety in every investment. This approach transforms volatility into opportunities while maintaining focus on ownership, income, and the realities of the balance sheet. Limit the frequency of checking quotes, establish clear rules for buying and selling, and view inactivity as a legitimate choice. Maintain detailed records of your decisions and their outcomes, as tracking patterns fosters self-control more effectively than mere predictions. The goal is not to outsmart the market, but to implement a process that thrives amidst uncertainty. Intelligent investing is a blend of careful analysis and sound temperament, allowing you to remain steady when prices fluctuate significantly. A solid definition distinctly separates investing from speculation, anchoring your decisions in safety and ensuring an adequate return. Asset allocation, diversification, and a margin of safety function together as a robust safety net against mistakes. These habits minimize stress and turnover, preserving returns by reducing cost and avoiding bad timing. Over the long term, they allow compounding to take effect, as capital remains invested through both enthusiasm and fear. Start the process by drafting a simple investment policy, then automate your contributions to ensure progress continues without constant oversight. Create a watch list along with an evaluation checklist, and practice the art of waiting for prices that truly reflect value. When market sentiment shifts, adhere to the same set of rules, ensuring you remain in control of your investments. If you're interested in more practical frameworks like this, subscribe and continue to develop a more composed investing process.